Now we're on 12.2, and this is determining payroll tax withholding on this section. So this is really just about what we're going to withhold from taxes. If I can get doesn't want to wake up. The first thing we're going to talk about is your payroll taxes. And those are from a business standpoint. Those are the taxes that are based on the payroll of your business. Most of you know that by law you're required to pay taxes. So a business is required by law to withhold certain taxes from all salaries. The amount that is withheld is based on your total earnings. So those figures that we figured yesterday, that's the figure they use when they're determining your what number to use to figure out what your taxes will be. It's important, just like in all of accounting, that accurate records are maintained, because if you have inaccurate records, that can make you have inaccurate payroll records or payroll tax records. And if you do that, you can be charged pretty steep penalties by the federal government. Also, state government can give you a fine for that also. Remember, just like we have all through the book, payroll taxes, any taxes, but payroll taxes included, are a liability for the employer until you have actually made that payment to the federal government. So when your assets equal liabilities plus owner's equity, it is a liability and it goes up on the credit side. The first payroll tax we're going to talk about is employee income tax. And this is the money that the employer must hold for federal income taxes based on your total earnings. They must be periodically, and I think a lot of times it's quarterly, but that may change based on the size of your business, forwarded to the federal government. There is no state that is exempt to this. All states, everybody in all states have to pay the federal income tax. In addition to that, many states also require state, city, and county income taxes to be withheld. And those of you who have jobs can see on your check stubs that you do have in the state of Nebraska state taxes withheld. So how are we going to know how much to take out of each person's check? Because everybody's check is different, everybody's amount of withholdings is different. Well, the federal government helps us out with that. They give us some tax tables that we're going to talk about in a little bit. But first of all, before we do that, we have to know, what does each individual employee want held out of their check? So when you first get a job, and you can change this anytime you want while you're holding that job, you're required to fill out what's called a W-4 form. And there's one in the book on page 346. We're going to look at an example here also, but this form just tells them how many dependents that you want to claim. And really what that is, that's called the withholding allowance. That's the deduction from total earnings for each person legally supported by the taxpayer, including the employee. So for example, using my family, we are still legally responsible for Derek. So that's where that who's legally responsible for who, he could become legally responsible for himself, but right now we're still claiming him. Same way if you're under 18, your parents are probably claiming you. Employees are required by law to have a W-4 on file. So if the auditors come, they have to have that in their drawers. Now, how do we know what factors affect how much income tax is withheld from your personal check? First is your marital status. Are you single or married? Second is the number of withholding allowances you've claimed. Now, keep in mind, if you take a married couple and a single person, and they both make the same amount of money and they both claim the same number of allowances, the married couple will have less withheld than the single person, because the single person is required to pay a higher number of percentage of taxes. Also keep in mind that the larger the number of withholdings, if I claim Doug, Derek, and myself, that would be 3 withholdings, then the less income tax they're going to take out of my paycheck, so my paycheck will be bigger. So the larger the withholdings, the smaller the paycheck. The amount, sorry, the larger withholdings, the smaller amount they keep out. Now there are some exemptions to that. There are some things that are exceptions to the rule, and those belong to certain low-income or part-time employees. You cannot claim exemptions if your income exceeds $750, and that includes more than $250 of unearned income. And unearned income are things that you didn't work for per se, so things like interest and dividends on money you have in the bank or invested. And you also can't claim exemptions if another person can claim you as a dependent on their tax return. So all that is saying is, in my family, Derek cannot claim an exemption because we are claiming him on as a dependent on our income taxes. Here is what a W-4 looks like, an employee's withholding allowance certificate. The steps in filling out one is first, it has the employer's name and address. Then it has the social security number. Then you want to make sure that your marital box is selected correctly. So if you're single or married, you want to make sure. And there's a couple different choices on the married. You can be married, or you can do married filing separately. So that is another choice on how much they keep out. Then you're going to write the total number of withholdings claimed, and when you get that form, on the back of it, it explains a little bit about your withholdings and how you want to pick how many you claim. And then once it's done, the employee signs and dates the form. And on here, it almost makes it sound like the employer is filling out those parts, but generally they give it to the employee, and the employee fills out the whole thing. Okay, on page 347 and 348 of your book are the withholding tables, or examples of some withholding tables. And the first page shows what it's like for single people on a semi-monthly pay period, and the second one is for married on a semi-monthly pay period. So you might take a minute and just glance at a couple of them and see if you're earning the exact same money, what the difference is, and how much money gets held out of the check. To simplify the process to calculate the earnings, the federal government prepares all these tables. They try to take every situation there could be and prepare a table. And if you look at the tables, each table has columns for the number of withholding allowances, rows for different age brackets. And then an employer can just glance at these and know. Also, a lot of those are obviously computerized, so they're in people's computers and they automatically figure them, but they all come off of those tables. So here is an example of an employee's income tax withholding for married persons on a semi-monthly payroll period. And if you just look, your first thing is you have to get the right table. So you check to see if they're single or married and make sure all the variables fit the table that you pick. Then you locate their total earnings, and then you just do the intersection of the wages and the number of allowances. And then that will tell you how much is going to get withheld from that person's check. The only other thing in this section is the Social Security and Medicare tax. And the Social Security tax is just a federal tax paid for old age and survivors, and disability insurance, and that's both called Social Security tax. The hospital portion of that, sorry, the copier's going off. The hospital portion of that is Medicare tax. And so those each have to be accounted for and also reported separately, and once again, they're a liability. It's Social Security taxes on your employee earnings up to a certain amount in a calendar year. And the maximum amount of earnings on which that tax is calculated is called the tax base. And that is a number set by Congress. So if you look in the book on page 349, you take total earnings times whatever the Social Security tax rate is, which in your problems they will give you, and that is your Social Security tax reduction. And also when you're doing the Medicare tax rate, the same thing works with it that works on Social Security. You just take your total earnings, you take that by the percentage that is your Medicare tax rate, and then that is your Medicare tax reduction. So there you go. That is section 12.2.